All right, let's get into it. The auto parts business, it's got to be one of the most reliable, consistently profitable games in all of retail. It's just a fantastic place to be. Which begs the question, right? Why is one of its biggest players, Advance Auto Parts, caught up in this massive, high-stakes, bet-the-company turnaround? Let's break it all down.
This number right here, this is everything. This is the single biggest tailwind pushing the entire industry forward. 12.6 years. That's the average age of a car on the road in the US today, a record high. And you know what that means, right? Older cars mean more repairs. They're way past their warranties, and that just creates this constant growing river of demand for companies selling spare parts. It's like a rising tide that should be lifting all the boats.
And yet, this is where the story gets really interesting. This is the big puzzle. In this amazing industry, you've got these absolute rock stars like AutoZone and O'Reilly, pulling in operating margins around 20%. I mean, that's just incredible. And then, you've got Advance Auto Parts, struggling to make just 3%. That huge gap, that chasm, that's where our story really kicks off. So, you gotta ask, how on earth did this happen? To really get a grip on the turnaround story, we first have to play detective and diagnose exactly why Advance Auto Parts, we'll call them AAP, fell so far behind. And trust me, these problems go way back. Okay, it all starts right here at the top line, with sales. This chart shows comparable sales growth, which is a super important health check for any retailer. And look at this. In 2023, while its competitors were growing at a really healthy pace, AAP was actually going backwards. They weren't just growing slower, they were literally losing ground, losing customers, losing market share.
But what's really fascinating here is what this slide reveals about the core financial problem. See, it's not just that App is selling less, they're making way less money on every single thing they sell. We're talking a 15-point gap in operating margin. That is a massive structural hole in the boat that has just been sinking shareholder value for years.
Now, a gap like that doesn't just pop up overnight. This was years in the making. It's the result of some really specific failures. A supply chain that was just a tangled mess, stores that were starved of investment, and then the final straw. A really critical blunder in 2022 when they decided to raise prices just as their competitors held the line. That move absolutely alienated their professional customers, the mechanics, and sent them running right into the arms of the competition. So, with the company basically in a full-blown crisis, the board did what you'd expect. They brought in a whole new leadership team, a new CEO, a new CFO, and their plan, well, it's not some revolutionary new idea. In fact, it's pretty much the exact opposite. The whole strategy is to stop trying to reinvent the wheel and just start copying the proven successful playbook of their rivals. It's the imitation game. And the absolute centerpiece of this whole plan is a complete overhaul of their logistics. They are tearing down their old, complex mess of distribution centers and building a modern hub-and-spoke system from the ground up. The goal here is actually pretty simple. Get the right part to the right mechanic faster and cheaper. Because in the pro business, speed is everything. This is totally non-negotiable if they want to win those customers back. At the same time, the new team is getting laser-focused. They're looking to sell off businesses that aren't part of the core mission, like Worldpac. Why? To simplify the company and pour every single dollar, every ounce of management's attention into fixing the main US stores. From an investor's point of view, that kind of intense focus is exactly what you want to see in a big turnaround. But look, let's be real, a turnaround of this size is never a walk in the park. It's not guaranteed, the plan sounds good on paper, but the road ahead is absolutely filled with risk. And yet, despite all that, we are just starting to see the first little green shoots of progress. And here is the biggest financial risk, boiled down to a single, pretty scary number, $1.95 billion. That's the new debt the company just took on to fund this whole transformation. They're basically borrowing a ton of money against a recovery that hasn't happened yet. That really raises the stakes if this plan starts to go off the rails.
And this quote just nails it. It perfectly illustrates the central question for any investor looking at this. The strategy itself, copying the industry leaders, is sound. It's a proven model that works. So the billion-dollar question isn't what they're doing, it's can they actually pull it off? Can this team execute a super complex, multi-year plan, especially after such a long history of operational fumbles? But right after talking about risk, here's that first tangible sign of hope I mentioned. 30 to 40 minutes. That's the new improved delivery time for pro customers, down from over 50 minutes before. It might not sound like a huge deal, but that is a critical metric. It shows that the supply chain changes are actually starting to work where it counts the most, with the customer who needs that part right now.
And it's not just that one metric. We're seeing other positive signs pop up. Parts availability, that's up. The bleeding in comparable sales has stopped. They actually stabilized. And their store footprint is in a much stronger position now. Look, these are the small wins, the building blocks they absolutely need to create some real momentum.
Okay, so let's bring it all together. What does this all mean for someone looking at the stock today? Is Advance Auto Parts on the brink of an incredible comeback story? Or is it a classic value trap? You know, a stock that looks cheap for a very, very good reason?
I mean, this table just says it all, doesn't it? The market looks at $1 of sales from O'Reilly or AutoZone and says, yep, that's worth $4 or $5 in company value. But then it looks at $1 of sales from Advance Auto Parts and says, that's worth less than $1. That massive, massive gap shows you just how skeptical, how unconvinced the market really is that this turnaround is going to work.
And that right there gets us to the heart of the investment thesis. If you're buying the stock today, you're not betting on its current performance, because frankly, it's terrible. No, you're making a bet on the future. You're betting that this new management team can actually execute the plan, that those profit margins will eventually recover, and that one day the market will wake up and re-rate the stock, closing that huge valuation gap with its peers.
So if you're going to follow this story from home, here's your personal checklist. 3 key numbers to watch like a hawk every single quarter. First, comparable sales growth. Are they winning back customers? Second, that adjusted operating margin. Is that massive profitability gap finally starting to close? And third, free cash flow. Is the company getting back to financial health? The trends in these 3 metrics will tell you everything you need to know about whether this turnaround is on track or heading for a ditch.
And that leaves us with the final defining question of this whole saga. The new playbook? It's a copy of a proven winner. We know it works. But is flawless execution even enough? Is it enough to close the gap when you're competing against 2 of the absolute best, most disciplined operators in the entire retail industry? That is the multi-billion-dollar question at the very heart of the Advance Auto Parts turnaround story.